Welcome to Daybreak, the podcast. It is often said that when you find yourself in a hole, the first thing you should do is stop digging. But stopping is not enough. The real first step is recognition, acknowledging that you are, in fact, in a hole, because you cannot fix a problem you refuse to identify. The textbook knowledge can guide you, but it's only when theory meets the reality that the experience begins. And today, we are stepping out of the textbook and into reality, into one of the most defining economic stories of modern Canada, the story of real estate, or the story of a boom that became a bubble. Stay with me as I will be right back. Welcome back to Daybreak, the podcast where we take a closer look at the forces shaping our world. Today we are talking about Canadian real estate, not just as an industry, but as a system, one that grew fast, overheated even faster, and is now facing the consequences of its own momentum. Let's begin. Let's begin in 2020. The world was in the grip of a global pandemic. Economies were slowing down. Uncertainty was everywhere, and governments were stepping in with aggressive measures to stabilize the situation. In Canada, the goal was simple: stimulate borrowing, encourage spending, and prevent economic collapse. The Bank of Canada wanted to provide an incentive to kickstart a depressed economy, so interest rates were dropped to historic lows. And on top of it, the government was dishing out loans and subsidies and monthly grants and bursaries to Canadians to support their businesses and personal expenses. Between March and October 2020, over $80 billion was distributed through the Canada Emergency Response Benefit, or CERB program, and almost 9 million Canadians received those payments. Alongside that, there was the Canada Emergency Business Account, which provided roughly $49 billion in interest-free loans to small businesses. These loans were partially forgivable under certain conditions. In total, you're looking at roughly $130 billion injected into the economy in a very short period of time. Now, not all of the $130 billion was perfectly distributed or managed, and the estimates suggested that $4 to $6 billion went to individuals who were not even eligible. And another $8 to $15 billion is estimated for errors and fraud. Some of that money may never be recovered, but let's connect it to the real estate. A massive amount of cash had entered the system quickly, broadly, and with minimal friction. And that kind of liquidity has consequences. And a portion of it found its way into investments. And what better investment than real estate? And that too in pre-construction condos, and over 100% profit potential within a short period of time. This excited Canadians, and nobody wanted to miss the bus or arrive late for the party. And the demand further heated up, and comparative bidding and multiple offers started becoming the norm as people started chasing deals. But before we go any further, we need to separate two terms that are often used interchangeably, especially by politicians, but are not the same: housing and real estate. Housing is a policy domain. It involves planning, zoning, density, infrastructure, transit, schools, long-term urban development. These are decisions made by governments. Real estate, on the other hand, is a business. It is driven by risk and return. Developers build based on demand. Investors buy expecting appreciation. It operates fundamentally within a profit framework. This clarity is key to understanding that housing is not real estate, and real estate is not housing, though interchangeably used so many times by our politicians. And when you combine cheap money, high liquidity, and strong demand, what you often get is hyper acceleration. And that's exactly what happened. Prices went up. In some cases, condo prices reached levels where cost per square foot climbed to unimaginable heights. Condos kept becoming tinier and tinier and tinier, and per square foot price kept going higher and higher and higher. Pre-construction units were being sold rapidly, sometimes with prices going up in large increments, while buyers lined up outside, literally. And people invested in pre-construction as all they needed to put down was a small deposit, and thinking that they would sell at a higher price even before it was built. That is speculation. And they leveraged, sometimes even betting their kitchen money. Speculative behavior increased with time. Not all buyers were seasoned investors assessing risk. Many were entering the market driven by fear of missing out, or by optimism, or by belief that prices would continue to rise indefinitely. And all during this phase, oversight was non-existent, or extremely limited at best. The system was moving fast, and no one was asking whether this was sustainable. Let's step back and look at the scale of what we are talking about. In 2020, the total value of Canada's residential real estate was estimated between $5.5 and $6 trillion. That is significant, especially when you consider that Canada's GDP that year was about $2 trillion. In other words, residential real estate alone was roughly 2.5 to 3 times the size of the entire Canadian economy. At the same time, the total wages and salaries in Canada were around $1.2 trillion. And the real estate sector contributed about $260 to $280 billion, or roughly 13% to the national GDP. Fast forward to 2025, and GDP rises to around $2.8 trillion, and real estate contributions roughly $320 to $350 billion, still around 12 to 13% of GDP, even in 2025. All these numbers show that real estate is not a small sector. It is actually a very much central to the Canadian economy. But what about foreign investment? What happened? In 2020, foreign buyers accounted for a relatively smaller share of residential transactions, roughly $7 to $15 billion. Historically, this investment has stood stable at between 2 and 5% of the total sales, concentrating mainly in Toronto and Vancouver markets. The peak foreign inflow was seen in 2021, which was between $10 and $20 billion. A typical pre-ban range was between 7 to 15 billion annually, which dropped to 2 to 7 billion after the ban in 2023. The foreign capital had stopped coming into Canadian real estate and started moving to US and Dubai markets. And both markets saw their greatest booms in real estate in pre-Trump years. But if you notice, the share of foreign investment in residential real estate of Canada has been very small, even during the peak years. Now, policy responses to address this included taxes and restrictions on foreign buyers that ended in complete ban on foreign investment in residential real estate in 2023, and it was recently extended. The stated intention was to reduce pressure on housing affordability by controlling the offer competition, or by cooling down the demand. But the demand was already cooling down, as the Bank of Canada implemented the fiscal measures and had already started a series of interest rate hikes that more than doubled the cost of home ownership in a short span of time. And policies have trade-offs. When capital is restricted, it does not disappear, it moves elsewhere. And so it did. It moved out of Canada. And Canada was left alone to rely on local economy to support the residential real estate, knowing well that Canadian economy wasn't big enough to bridge that gap that was left by the investors leaving the country. The interest rate had already climbed so high to cool the market or to cool the economy down that affordability had already become an issue, not only for the first-time buyers, but for everyone across the board. The investment in real estate was not attractive anymore. And the dream of home ownership, the Canadian dream of home ownership, had just been converted into a Canadian nightmare. Textbooks did not predict that. Experience taught that. People lost deposits as values came tumbling down and many could not even close. So they left hundreds of thousands of dollars on the table with the builders. The builders were also stuck with the inventory and cost of carrying the inventory, and much of it still remained unsold. Which brings us back to the central issue. If the problem is not clearly defined, the solution will miss the mark. Efforts such as reducing development charges or adjusting taxes claim to improve affordability, but they also interact with the complex system of existing owners, investors, and market expectations. It benefits builders only to offload their inventories as the new condos become cheaper. But it also pulls the real estate market further down in a domino effect. Availability of cheaper new condos will discourage resale buyers from existing more expensive condos that were bought between 2018 and 2022. We cannot punish people who trusted Canada in the past with their investments. And real estate is not isolated. It connects to banking, to employment, construction, and consumer confidence in general. It is 13% of our GDP. Interfering in one area will have ripple effects across many others, and everyone can see that. So where does that leave us? You see, markets by nature go through cycles: expansion, peak, correction, adjustment. The question is not whether cycles occur. They always do. The question is how we respond to them. And the policy plays a role, and so does market discipline. So does transparency, regulation, long-term planning. The lack of effective planning and oversight in the past is forcing an extreme corrective measure, but it still doesn't solve the problem. We are still focusing on the same 20 cities. Instead of expanding the infrastructure to urbanize more Canada, we are increasing density in the same old urban centers, instead of creating new urban centers by investing in new infrastructure and expanding outwards. We are still digging the hole. And we do not look the issue in the eyes because it is ugly. We must encourage legitimate debates about affordability, about access, about speculation, and about the balance between housing as a need and real estate as an investment. Let us not confuse Canadians with the political jargon or by patronizing a segment of the populace. They need to know if they will ever recover their investments. They need to know that Canada is an investment-friendly country and has policies in place to protect them because they don't see it. They also need to know the existing owners will lose more money as the Canadian government continues to apply populist measures to inspire sentiment instead of real measures to protect their investment. When the whole economy is in a free fall, these actions are completely against the spirit of a free economy, and these crutches will take away from the market mechanism of self-recovery. But those debates require clarity about definitions, about data, and about goals. Because at the end of the day, the principle still holds that if you find yourself in a hole, the first step is stop digging. And the next step is to understand how you got there. But before I end this podcast, I will ask a question, and that is land buying the new pre-construction condo of today? It's time for clarity. This is Daybreak time. Thank you.